The S&P 500 is sold as your safest path to wealth. But what if I told you it's actually holding you back and there's a better way? After over 10 years of investing and averaging over 30% a year, I'm going to share my one discovery that flips the script on everything you've been told about. Just buy the S&P 500 and you'll be absolutely fine. Because the truth is, that advice, it's everywhere, but it's old and it's lazy. So in this video, I'm going to show you the numbers, the reasons, the blueprint, and the alternative that's been quietly crushing the S&P 500 for years. And by the end, you'll understand why 30% a year isn't just possible, it's very repeatable. And no, it's not what you think. Millions of people are investing in the S&P 500 thinking it's the smart play, but they're unknowingly leaving 6, even 7 figures plus on the table. I was stuck watching my money grow slower than inflation until I realized the problem wasn't me, it was the strategy. Imagine this, it's 1957, you invest $1,000 in the S&P 500. Fast forward to today, that's now worth around $916,554, a staggering growth of around 91,555%. Sounds mind-blowing, right? Until you realize this. Over that same period, inflation-adjusted returns dropped that to about $81,000. This means the inflation-adjusted return is just under 8,010%, as opposed to the original return of around 91,555%. And what if I told you there's a way to outperform that result by more than 600% using a process that takes just minutes a week? And more importantly, how this growth comes from investing in just a few good stocks each year. So here's what they don't tell you. The S&P 500 isn't just the 500 biggest companies in America. To get into the index, a company needs to be US domiciled, be listed on the New York Stock Exchange or the NASDAQ, have a market cap above $18 billion, have shown a profit in the last 4 quarters, and most crucially, be selected by a committee at S&P Global. So that's right, there's no automatic entry. You could tick every box and still get benched because the committee picked someone else. And while that gives the index some protection against hype stocks, it also makes it something else. It's not truly passive. It's pre-approved by a committee, which makes it a curated portfolio, just one pretending to be, well, neutral. Palantir is a recent example of a stock that met the requirements and was added to the S&P 500 and then later transitioned to the tech-focused NASDAQ 100. But even with all that filtering, the S&P 500 only averages around 10.5% a year. So let me say that again, 10.5% a year with all that filtering. Now, that's fine if fine is your goal or what you have been told to settle for, because you can't do any better, which is very common online. A lot of influencers who don't know anything more than investing in an index fund themselves or dollar cost averaging, telling you that you do not have the ability to outperform the market. It's kind of cheeky, right? So here's my question to you. If just a handful of stocks are doing the heavy lifting, why would you settle for owning the whole index? Instead, focus on consistently buying these top performing stocks. If you want to learn how to spot these strong stocks and profit from big market moves, download our stock market blueprint. It outlines a simple process you can start using in your investments today. You can find the link in the description below. If you're a working professional or business owner who actually wants to grow wealth, not just preserve it, then let me show you what 30% plus annually actually looks like. Now, over the last 15 years, $1,000 invested in the S&P 500 becomes over $7,000 at 10.5% a year. Using our blueprint at 30% a year, that same $1,000 grows to over $51,000. That's a 624% increase in profits. That's not fine. That's on the way to being extraordinary. Now, let me back up a little. When I started investing, I did what everyone else was doing. First, I was day trading because, of course, the allure of quick riches in my 20s, well, sounded way too appealing. However, I quickly learned its shortcomings when many don't. The more I researched index funds and set and forget, the less appealing that became to me. Index funds just seemed slow and I wasn't really learning anything, and I knew that I was leaving a lot of money on the table. However, day trading was uber time consuming and, well, very, very inconsistent. It all changed when I discovered trend following, which first taught me to stop treating the stock market like a casino and instead start treating it like a system. Through training and backtesting, I started seeing the same patterns repeat in winning stocks. Patterns I'll break down in just a minute. I then got really good at catching these winning stocks in real time. Here's what we do differently. We stopped fighting and predicting the market and instead aligned and follow her. In other words, we follow the market's trends. We stay in when the market is strong and we step aside when it's correcting. So the question is, how do we find the Nvidias before they actually blow up? Most investors miss the first step, not because it's complicated, but because it's hidden in plain sight. Step one, the monthly time frame. We zoom out. We look at the monthly chart of the S&P 500 to decide whether the overall market is trending or not. If the S&P 500 is flying with all-time highs, great. We're now in a bullish environment. But if it's chopping sideways like it did between January 2022 and January 2024, we stay cautious. However, regardless of what the S&P 500 is doing, we keep scanning and analyzing the market at the end of each trading day to filter out any breakout stocks that are pushing up even when the index is flat. These are the stocks that are outperforming or leading the index. Remember this, the index is an average of a group of stocks. Logic says that there will always be stocks outperforming the average. So as investors, we must have a process to find these stocks and invest in them. Now that's what an accomplished investor does. As a case study, in 2022, when the S&P 500 declined by 28%, McKesson Corporation, a healthcare stock, moved up 65% and has moved up a total of 170% since, while the S&P 500 has only climbed around 20% in the same time period. Let me tell you how this saved me from brutal losses in 2022, as many faced. Here's where most people go wrong in timing the market. Us buying these stocks that are moving up while the index is moving sideways is a key ingredient to how we get significantly better returns than the market average. We are making profit while those just investing in the index aren't. And when the index starts moving up, our stocks that are already moving up start gathering momentum, allowing us to compound our profits further. Okay, so that's step one. Step two is moving from the monthly to the weekly time frame, and we turn to our trend filter. If it's green, game on. The stock is moving. We also want the price of the stock to be above the 200 weekly simple moving average. That is actually our foundational signal that the stock is healthy and not just hyped. Step three is where the daily time frame comes in. This is where we fine-tune our entry. Now, first of all, we want to ensure that it is moving in the same direction as the weekly time frame. Our trend filter must also be displaying green bars above the daily 200 simple moving average, confirming alignment with the weekly time frame and bullish momentum. And then we check the 50 and the 20-day simple moving averages. If price rarely falls below the 20 simple moving average, we know it's trending very well. If it dips to the 50 simple moving average, it's more volatile, but still a possible setup. See what we're doing here? We're not guessing, we are following. Okay, let's take Nvidia. It's up over 26,000% in the last 15 years, which is just staggering. Or Progressive, it is up 1,300%. Not as impressive as Nvidia, but still a massive growth. Meanwhile, the S&P 500, well, it's just up 388%. You see, this is the difference between owning everything, which sounds sexy, but is underwhelming, and owning what's working, which has been made to sound unachievable, but is where the wealth is made. And here's something that should resonate with you. Our system helps you find those winners without needing to spend hours reading news or chasing headlines. Life is busy. We simply don't have any time for that. If you're tired of inconsistent results, if you're done with the uber slow returns or day trading and chasing hype, or trying to time the market and getting it wrong, and if you're ready to follow a proven process to finally start growing your wealth, then don't settle for fine. Don't settle for 10% a year when 30% plus is possible and repeatable. But here's the truth. You can achieve way better than average without being glued to your screen all day, every day. You don't need 500 companies. You don't need to check your portfolio every day, all day. And you definitely don't need to ride out years of drawdowns just to stay in the market. You need a proven plan that finds the best performing stocks. A plan that is simple and repeatable. A plan that compounds your wealth. A plan that adapts around your busy lifestyle in minutes a week without compromising on profit and time. If you invested $100 a month into the S&P 500 for 15 years, you'd have over $250,000. Not bad at all. Now, that number might sound impressive, but what if I told you using the exact same money, you could turn that into over $1.6 million? That's the power of following a system that actually works, one that adapts to the market and focuses on momentum, not guesswork. But here's the thing, knowing the system is only half the battle. If you can't quickly spot which stocks are actually showing strength, you'll miss the move. That's why in the next video, I'll show you how to identify a potential winning stock in under 3 seconds.